Private credit's new role in infrastructure, what CFOs must know. If your organization is planning to finance an infrastructure project in 2026, a manufacturing facility upgrade, a grid connected generation installation, an industrial decarbonization build out, the person on the other end of that financing conversation is almost certainly not a banker anymore. They work for a private credit fund. They manage patient, long duration capital. They can move faster than a bank and structure more flexibly than a bank, and they will charge you for both of those advantages. This is not a temporary market condition. It is a structural shift in how industrial infrastructure gets financed in the United States. CFOs and operations executives who are still approaching infrastructure capital planning as if the traditional bank lending market is the primary option are working from an outdated map. The bank retreat is structural, not cyclical. The first thing finance leaders need to understand is that traditional banks have not temporarily stepped back from complex industrial infrastructure lending. They have been systematically pushed out of it by regulatory forces that will not reverse. Reforms following the global financial crisis, including higher capital requirements and stricter risk weighting rules, made it significantly more costly for banks to hold riskier corporate loans on their books, encouraging many lenders to retreat from leveraged or bespoke financing areas. Industrial infrastructure debt, long duration, asset heavy, often illiquid, sits precisely in that category. The structural retreat of bank lending from middle market loans and certain asset types shows no signs of reversing, even with the prospect of regulatory relief under the current administration. The 2023 regional banking crisis accelerated this further. The void left by banks retreating from lending to companies below investment grade or not rated is now being filled by private credit. For industrial operators seeking project-level financing, the practical effect is a dramatically narrowed pool of traditional bank lenders willing to underwrite deals on terms that work. Who filled the gap and how big it got? By mid-2025, global direct lending assets had reached roughly $979 billion, up from about $148 billion a decade earlier. The broader private credit market totaled around $1.8 trillion, including more than $500 billion of committed but undeployed capital. The private credit market now matches the broadly syndicated loan market at $1.5 to $2 trillion in direct lending alone and is forecast to reach $3 trillion by 2028. The firms deploying this capital are not niche players. Ares Management raised a record $113 billion in 2025, managing over $622 billion in assets. Blackstone, Apollo, KKR, and Carlyle together now manage a combined $1.5 trillion in permanent capital, and they are actively prioritizing the sectors that matter most to industrial operators. Looking to 2026, priority sectors include energy infrastructure, digital infrastructure, defense and national security, and next-generation manufacturing, all requiring patient institutional capital. In 2025, Apollo and Standard Chartered announced a $3 billion partnership to accelerate financing for infrastructure, clean transition, and renewable energy. Early this year, Blackstone lined up a $2.6 billion debt package for a power grid merger, a deal that signals grid-adjacent businesses are now prime targets for large-cap private equity and energy transition funds. This is where the capital is. The question for CFOs is not whether to engage it. It is whether they understand the terms well enough to do so deliberately. What private credit offers and what it costs. Private credit's advantages over traditional bank financing are real. Speed and flexibility. Private credit's advantages include speed of execution, certainty of funding, flexibility in structuring, and a greater risk appetite and willingness to provide capital when traditional lenders retreat. This translates into structures that banks typically won't offer: interest-only periods, delayed amortization, and covenant packages tailored to specific cash flow profiles. But the cost is meaningful. A sustained spread premium exists between public and private markets, allowing investors to earn higher yields for lending privately. For borrowers, that spread typically runs 100 to 300 basis points above comparable bank financing, depending on asset type, credit quality, and deal structure. A project that cleared a return threshold at bank financing rates may not clear it at private credit rates. This recalculation needs to happen before a project goes to final design. The covenant question nobody is asking loudly enough. The most consequential and least discussed dimension of this shift for industrial borrowers is covenants. Private credit deals are negotiated bilaterally. That gives borrowers flexibility in structuring, but it also means the lender has considerably more leverage to install operational conditions that a syndicated bank loan would never include. Maintenance covenants tied to coverage ratios, capital expenditure restrictions, and change of control provisions impose real operational constraints. If facility energy costs spike unexpectedly, or if a decarbonization project runs over budget, the covenant implications can be serious and fast-moving. Finance teams that have primarily dealt with revolving credit facilities and investment-grade bond markets are often underprepared for the active monitoring and covenant management that private credit deals demand. That gap is where problems tend to appear. The risk that isn't being priced in. There is a cautionary note that deserves space here, and it comes from the institutional finance community itself. Around 15% of private credit borrowers are no longer generating enough cash to fully service interest, according to Goldman Sachs, and many others are operating with little margin for error. The market has grown so rapidly that underwriting discipline is uneven. In the direct lending market, payment in kind income, a signal that borrowers are deferring interest because cash is tight, reached roughly 8.8% in the third quarter of 2025, up from 4.2% pre-pandemic. Persistent increases have historically coincided with borrowers seeking to conserve cash. This is not an argument against accessing private credit. It is an argument for selectivity. Organizations should be evaluating the lender as carefully as the lender is evaluating the borrower, scrutinizing track records, workout approaches, and documentation quality. A private credit deal with the wrong counterparty is not just expensive. In a stress scenario, it can be operationally disruptive in ways that traditional bank lending rarely is. What CFOs need to decide now? Remodel your cost of capital assumptions. If project hurdle rates were set when bank financing was the baseline, they need to be revisited. Private credit premiums of 100 to 300 basis points are not temporary. They are the new normal for a wide range of industrial infrastructure deals. Build relationships before you need them. The organizations accessing the best private credit terms in 2026 established lender relationships before a specific financing need existed. Private credit managers, like all relationship-driven capital sources, price that history into their terms. Know what your covenants actually say. The operational constraints embedded in private credit documentation need to be reviewed not just by legal and finance, but by the operations and facilities teams who will manage within them for the life of the deal. Evaluate lender quality, not just lender availability. Diversification, strong underwriting, covenant protections, and experienced managers are essential. While oversight is increasing, private credit remains less regulated than banks, preserving flexibility but also preserving risk. Manager selection is a material decision, not a back-office function. The bottom line, global banks face stricter capital requirements under Basel III-4 and are retreating from corporate lending. Private credit firms are filling this void with permanent, non-runnable capital that is structurally better suited to long-duration infrastructure assets than deposit-funded bank balance sheets. This is not market disruption. It is market maturation. The lenders are different, the structures are different, the terms are different, the risks are different. The organizations that understand this clearly will execute faster, pay less for their capital, and avoid the operational disruptions that come from financing surprises mid-project. The ones that don't will keep wondering why deals that looked straightforward on paper are taking longer, costing more, and creating more friction than expected. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.